we put together a fairly heavy piece for you here, just as an FYI. Using SKEW in low VIX. This would definitely be considered low VIX. Tony, what's the VIX right now?
Ooh, VIX or
Yeah.
/ VIX?
Yeah.
It's in the 15 handle. 1462, down 39 cents. It's the Guild Theater, by the way.
Guild Theater, you're right. What's the VIX trading for?
VIX,
Yeah.
1462.
1462 in the
Down
VIX.
40
And what
cents.
is the SKEW?
SKEW? Is that what you're asking?
Yes.
Okay. SKEW is trading 150, almost 158. Oh, that's where it closed.
Almost 158.
High. SKEW is very high.
So the SKEW is at the very, very high, and the SKEW is very high, and the VIX is very low. Okay, perfect. All right. The VIX is a linear combination of out-of-the-money option prices intended to give a regulator-friendly approximation for the volatility of the SPX. At tastylive, we generally view high VIX as a good reason to deploy more capital to short premium trades. After years of historically high VIX, option premium has recently come down sharply. SKEW is similar to VIX, but places a higher emphasis on further out-of-the-money option prices, giving a sense of the market's expectation for large moves, especially when that expectation is understated by the VIX alone. So, when volatility doesn't help us decide what trades to place, can we turn to the SKEW to evaluate our short premium positions? What do you think, Mr. Batista?
Can we turn to the SKEW to evaluate our short premium positions? I don't know. My inkling would say no, but I don't know.
What we have seen,
and this is know the context.
What we have seen, and this is very common, is that when volatility is low, the SKEW is high. That means when volatility is low, outlier risk is high. We've seen the opposite. When the VIX is high, SKEW is low. If you remember, through most of 2022, the SKEW was down around 120-ish, and volatility was at 25. Now that we've completely flipped around, SKEW is at 158 and volatility is at 14. So 158, a lot of outlier risk. That means, the risk of a big move. When volatility is really high and the SKEW is really low, very little risk of a big move. Okay, just so we're clear what that all means. Next slide, please. So we did a study, and we looked at 10 years of data in the SPY options, as well as the VIX and the SKEW indices. The SKEW is just a price. We considered selling the 45 data expiration SPY Strangles at a variety of deltas and held through expiration and managed at 21 days, but only looked at these trades. But only looked at those trades placed when the VIX was 16 or less, because it is now. So we're talking low VIX, high SKEW. We contrasted the performance of these low volatility short premium positions in high and low SKEW. For this study, we defined the high or low SKEW above 130. Okay, above or below 130. So SKEW, the cutoff was 130. Anything above 130 was high. Anything below 130 was low. And this is VIX under 16. Okay?
Go.
Let's do it. So the first thing. Now, this is really complicated, so you just got to bear with me because there's a lot of information here, and you go back to it later, and you can read through it all yourself and do any of that. But any SKEW at 21 DTE, so it doesn't matter. Take the SKEW out of the equation. These are just the numbers of a 16 delta short strangle in the SPY. Okay, regardless of SKEW, but low implied volatility. So this is implied volatility under 16, the VIX under 16. Now you remember what we've said many times. Implied volatility low does not change your pop. It just changes the amount of money you can make. So when we kind of go to the 16 delta strangle, you're at 81%. That is virtually the same as it would be in high implied volatility. So your pop is going to be basically the exact same. The 10 delta is 83, the 16 delta is 81, the 20 delta is 80. They're all the same pops. The difference is, you're making, generally speaking, in low implied volatility, you make a little less money. And there's the amount of average P&L you make per trade, and there's the CVAR on the bottom line, which is now available on the Tasty trade platform. Okay, let's go to the next slide. So now we have low skew and low implied volatility at 21 DTE, which doesn't happen very often because most of the time you get high skew in low implied volatility. But this is managing at 21 days. This is when you have a low skew index. Now we don't have this currently,
Right.
but you can see
just
right
the opposite.
We have kind of just the opposite, but you can see right here, the win percentage is virtually the same, but the difference here is the difference here is that the P&Ls are significantly greater. Low skew, 21 DTE. You don't get this very often, all right? Because most of the time, when you have low implied volatility, you have high skew. But with the few times that we did, the numbers are pretty impressive.
They are impressive.
But we don't have that situation right now, and the CVAR is really low. Let's go to the next slide. So this is what we have right now. Now look at these numbers. This is where we are in SPY right now. High skew, low implied volatility. And the pop is the same. But look at these numbers. They're all negative. And the CVAR is really high. Go back one slide.
Sure.
So this
complete
is
opposite. You really would love the other.
Yeah, Jacob's.
This is what you want.
Jacob's argument is that there's. We always say there's nothing to it. You really can't trade it, right? The skew. But that's the argument that we used to say. The pops are all the same, but this is low skew, low implied volatility at 21 DT. Put a trade on at 45 days. Take it off at 21 days. Every single number on here, the average P&Ls are positive, but and the CVAR is super low. Because the skew really recognizes outlier risk. When you go to the next slide, slide 5, all the numbers turn negative. This is where we are right now. This is why it's a very difficult period when you have a high probability of profit, but you have high skew, low implied volatility, high CVAR, negative P&L. And this is over a long period of time. I forgot what's this, almost 20 years. Let's go to the next slide. So now we changed everything to expiration. So any skew at expiration. So the pop numbers are going to drop a little bit.
Go to the next.
This is just.
Oh, this is any skew.
This is any skew.
Got it.
Just low implied volatility. You make money. Okay, over time. So that's why you keep doing the trades. Now go to the next slide. So this one, we go back again to low skew, and we hold it to expiration in low implied volatility. And you
I want that squirrel, Daddy.
Of course you do, because you make money. Because this one, when you have low skew without the outlier risk, you make money. Then you go to the next slide. Here's your high skew at expiration and high skew holding all the way to expiration in low implied volatility, and all the numbers are still pretty much negative. They're about a scratch on the 16 delta strangle, but the CVAR is higher. Again, just explaining, this is where we are now. High skew, at 21 days you lose, at expiration you pretty much lose. There's no berry here.
Right.
Next slide. So in general, as short premium traders, and this is really good info, we should dial back our positions when volatility is low, which we do. That's the whole thing. When the VIX is low, you reduce the amount of money you have in play. We do this both for risk-reward reasons and to make sure we have the buying power available to take advantage should volatility increase. When skew is low, along with the VIX, however, Strangles continue to be generally winning trades.
That's not what we have now.
The last bullets we have now. Low VIX, high skew environments were an exceptionally risky time to play short premium trades.
Hold on one second. Think about it. Skew is really the further out of the money options. And when volatility is high in the skew, you would think that you were getting more bang for your buck. Really what he's saying here is when skew is low, along with VIX, then the Strangles really work well.
Yeah, and when the VIX is low and the skew is high, which is what we have right now, it's a risky time. The only SPY strangles that were net profitable were the very far out of the money and held through expiration, which is naturally high risk, low reward positions.
So Sadov, even though you're having a good day today, it's not you, it's SKEW.
No, it's pairs.
It's not you, it's SKEW.
It's not you, it's SKEW. It's pairs trade. I mean, it's funny. This is why the business is so weird. This morning when I came in, I'm like, and I was pretty much feeling like this could be a good turnaround day, but
you did.
But this morning I came in, I'm like, okay, every position I have on sucks. Mm-hmm. Every position I have on is good. How do you know?
Because it's not you, it's SKEW.
It's an hour later, right?
We're going to take a quick 90-second break and come back. We got more Tasty Live after this with Oh Joy, your friend and mine, Mr. Scott Sheridan, coming up next. We're back in 90 seconds.